Yeah, and the nice thing about the energy number, it was specifically gas prices at the pump. And so I know a lot of people are going to be in much better shape with lower gas prices. I mean, their energy can come down and not necessarily have a big impact on us day to day, but when it's gas prices at the pump, that's certainly a good one. So, yeah, overall, I think the CPI numbers were pretty encouraging.
Welcome to the Bar Down Investing Show. Here are your hosts, Kyle Wilson and Jay Scott.
Hey there, and welcome to another episode of the Bar Down Investing Show. Once again, I am Kyle Wilson, as of now, still Ashley Wilson's husband, and I'm here with my best friend in the whole world, Mr. Jay Scott. How's it going, Jay?
Oh, that's so sweet. I am doing well. I am energized, energy. Ready to get
It's not going to stick, man.
I like it. Come on. It's such a good nickname.
Yeah, I don't say, I'm not going to be calling it yet, but yeah, let's check in for the week. You got any wins to talk about this week?
Yeah, so let's see our check-ins. This is where I talk about investments made this week. I have a losing investment to announce this week.
Uh-oh.
So anybody that listened to our predictions podcast last week, the week before, knows that you and I were talking about Tesla stock and how we both felt that Tesla was underpriced. We both predicted about a 50% bump in Tesla stock value over the next 12 months. And so I said, okay, I never buy stocks. Anytime I buy stocks, they do horribly. But I decided, okay, if you and I both agreed that Tesla had a shot at like going up 50% this year, I was going to put some money in Tesla. So literally Friday before the holiday, before New Year's, I put some money in Tesla. Wake up Tuesday morning and open up my stock ticker because I'm excited to see how it's going to open after the long weekend, and it opened down 13%. So that was my investment. Right. That was my investment. I invested in Tesla, down 13%. As of today, it's almost back to where I bought it, so that's good. But just a good reminder that I shouldn't be investing in the stock market, and that's why I love real estate.
Yeah, the roller coaster of the stock market. I considered that as well, but then I looked in and I realized I don't even have a stock account anymore. It's been years, and the only stock accounts that I have are my kids' custodial IRAs. And I didn't feel like I should be gambling, picking individual stocks on my kids' IRAs. So luckily I avoided that, but it looks like you're doing okay with that. Okay, perfect. Next, scorecard. I have a big scorecard announcement.
Nice.
We talk about subscribers. We always call out individual subscribers. We have a minor celebrity subscribed to our podcast for the first time last week.
Really?
Jay Scott. Jay Scott subscribed. I guess you were saying like, oh, I haven't listened to our podcast yet. I'm like, you don't subscribe. It doesn't. He's like, I think I do. And he was like, well, it should pop up right on your phone like the moment it comes out. And we realized that Jay doesn't subscribe to our own podcast. So we have at least one new subscriber. Mr. Jay Scott is a subscriber.
So we actually have. Yeah, we actually have on YouTube 62 subscribers total. On Apple, we now have Apple Podcasts. We now have 2 5-star reviews. So whoever left that second review, thank you so much. And yeah, I think we're crushing it. 2 reviews and 62 subscribers. I don't know how this thing isn't going to go viral.
I know. We doubled our amount of ratings as well. If we can do that, awesome.
If we can do that every week, we'll be at what, like 14 trillion by next month.
Yeah, I wish I remembered that analogy where if you had an eyedropper and you did one drop of water into a football stadium, then how it exponentially grows. But great. The most important segment next is the rock updates. I know this. You wait on bated breath for my rock updates every week, and so we just had the holidays, and the rock obviously has kids, and I think he has a 4-year-old, and the 4-year-old got some Lego for Christmas, and so it showed the rock trying to do Lego, and he is just awful at it. So. Just so everyone knows, nobody's perfect. If you thought The Rock was perfect, he can't do Lego. So there's my Rock update for the week.
Are you a Lego guy?
I love it. That's all I did as I was a kid. My one daughter is so into it. Our entire wall in our playroom is just all Lego sets, and it's great because I could pull out all my old Lego sets. My parents kept them, and so she does them all by herself now. So that kills an hour. She'll just go and sit down and do Lego. So it's awesome.
Yeah,
Anytime you can kill an hour with your kids without having to occupy them, it comes in handy.
Yeah, we had a 4-year run with Legos, but my kids finally are preteens. Actually, one just turned into a teenager, so we're a little bit past that now.
Oh, don't tell me that. Okay, let's talk about some headlines because we actually put the recording of this off a day because the new CPI headlines came out. So this literally just came in this hour, the new CPI numbers, and there's a couple headlines, but I know what the headlines are going to say. We won. Inflation's over. It's done, right?
Yeah, I guess that remains to be seen, but certainly we're in a good trend, a trend that looks promising. Over the last few months, we've dropped from like 9.1% to inflation. Our CPI number on an annual basis is at 6.5%, so that's trending down nicely. But more importantly, if you look at the month over month, last month, December, we saw negative 0.1% CPI growth, meaning we actually had some deflation last month. The price of stuff actually came down for the first time since I believe it was April of 2020. So right after the pandemic started, people locking themselves in their house, toilet paper not being available, all that stuff that we all remember fondly. For the first time since then, we actually saw a month of prices declining. So between that and I think like the 0.1 or 0.2 the previous 2 months, literally like inflation now is below the Fed target. Now, again, it's only the last 3 months. That could certainly change over the next 3, 6, 12 months. But for the time being, it's looking like things are on a good trajectory in terms of inflation.
Yeah. So if you look, if you go all the way back to August, reading back to August, the month over month, August was nothing. September was 0.1, October 0.4, November 0.4, December, as you said, we were negative. So if we're looking at almost 6 months here, it's taking a trend. It's looking pretty good. And a big reason that it went down this month was energy. But even if you look at the core CPI, which strips out energy and food for their volatility, the numbers were still pretty good. It went from 6% last month to 5.7. So it's still trending down. It wasn't negative. It was up 0.3 in the month, but still, if you annualize that, that's I'll take it at this point.
Yeah, and the nice thing about the energy number, it was specifically gas prices at the pump, and so I know a lot of people are going to be in much better shape with lower gas prices. I mean, their energy can come down and not necessarily have a big impact on us day to day, but when it's gas prices at the pump, that's certainly a good one. So yeah, overall, I think the CPI numbers were pretty encouraging.
Yeah, it's a little too early to tell how the markets will react, and people are going to hypothesize what Jay Powell's going to do based on these numbers, and we still have the jobs report that we're waiting on for that, but that's another issue. So I don't think we have much more to discuss on that because it's pretty early as far as moving that to issues. So we can move on to the next potential headline, where it talks about how Americans have been leaning heavily on credit cards amid inflation, which I thought was super interesting.
Yeah, I think the headline I saw yesterday that kind of spurred this discussion was something along the lines of now close to 50% of people are carrying credit card balances again. And that's up from something like, it was under 40% last year. And now we're close to 50% of people have credit card balances that they aren't paying off every month, which is just huge. And I know we've seen a spike in just consumer debt and credit as well.
Yeah, that's something we could discuss more. So why don't we put a contingent, move that down to the issues list as we look at the next headlines. So the next headline that I got, top central banker says Fed officials screwed up on inflation. I don't think that's any surprise. Everyone kind of accepted that the Fed, with their whole transitory speak, was wrong about that. But it's nice to see that some of these Fed officials are coming out and admitting their mistakes.
Well, I still find it funny because that whole is inflation transitory? Is it more sticky? We never really defined what that means. Like, is 10 years not transitory or 6 months not transitory? Because I honestly, I mean, I think what we've seen, it's been bad, but it's still been relatively transitory. Like we saw a big spike in inflation that correlated to some supply chain issues. Certainly, flooding the economy with ridiculous amounts of money didn't help. But there was a lot of correlation between what we saw with inflation and what we saw with supply chain constraints. And so, to some degree, you can say that as supply chains have gotten less constrained, especially over the last 6 to 12 months, inflation has started to come down. And so, to some degree, I'm not convinced that it wasn't transitory, but I know people don't like to say that because transitory we kind of think of as, okay, it's just going to be a couple of weeks or a month or two. I think a year or two can still be transitory, assuming that there's some other external factor. And again, I think supply is that external factor that was driving inflation. So I think it still remains to be seen if inflation is going to be an issue for the next 2, 5, 10 years like it was back in the 70s, or if we have it under control and we can now move forward.
Yeah, we discussed inflation in depth in our last prediction podcast, so I don't think we need to get too much more into it. It's a constant topic of discussion with everybody else, so I don't think we need to belate it anymore. So let's look at the next. The next headline is talking about lumber prices, which I don't know if you remember during the pandemic, that was like number one. Lumber prices went up 40x at one point, and now we're talking about they've hit the lowest level since the 2020 numbers. So that's great for home builders, at least.
Yeah, well, it's great for home builders if you think of it from the perspective of now home builders can build a lot because lumber is cheap. It's not so good if you think of it from the perspective of the reason it's cheap is because home builders have stopped building. I'm not sure which one of those it is.
If you look at it, I think the home builder confidence index fell for the 11th straight month in November to the lowest level in a decade. So that would make sense if you're just talking about supply and demand.
Yeah, and it was funny. You brought this up earlier, and I actually hadn't been on top of this news, and so I was looking at headlines over the last hour or two. And you made a really good point earlier that the headlines make it sound like there's a lot of optimism in the home building sector right now. Even though, yeah, the home builder index has been down, it looks like home builder stocks are on the rise. And I know some well-known pundits are talking about how home builder stocks are likely to do well over the next 6 to 12 months. And so despite the fact that a lot of people think we're heading towards a recession, a lot of people think we're heading towards a housing correction, a lot of people think that there's going to be a big slowdown in the economy, for some reason, there's still a lot of optimism around home building. So what do you attribute that to?
Maybe a little wishful thinking. It's one of those things that it's good to see the numbers come down, but then once again, back to supply and demand. Is there demand for brand new houses right now with where mortgage rates are? But it is a lagging effect as well. There's the people who already started building houses, even as lumber prices went up, they kind of had to finish in for a penny. Versus now, it's kind of okay. Where do you believe the economy is going to be in a year? All of these projects take a year and a half to complete from start to finish. So are we going to be pulling, trying to buy land, get permits, and do all, put all that upfront work if we don't know where the economy is going to be? So I don't envy the home builders right now because I don't know what I would be doing.
Yeah, and you hit the nail on the head earlier when you said a lot of it relates to mortgage rates right now. And it's funny because looking through a lot of those headlines over the last couple hours, knowing that this topic was going to come up, I realized that there's a lot of optimism around mortgage rates as well. A lot of people think mortgage rates are heading down at this point, which, I mean, hopefully that's the case. I don't know if it is. We've talked about the fact on our predictions episode that we think mortgage rates will probably end the year kind of where they started, which would be, I don't think necessarily a bad thing, maybe even a little bit lower. But there are a lot of people out there who seem to think mortgage rates are going to head down in the short term as well. So I guess that remains to be seen.
Yeah, well, we'll know a lot more if we see that that Fed start to come down a little bit with their interest rate hikes. So do we want to discuss that a little bit more? Do we want to talk about credit cards and consumer debt?
I think that's the topic that I don't think has been talked about enough, the consumer debt topic. And we're just starting to hear about it. So I think if we talk about that now, maybe we can be on the leading edge of this discussion, as opposed to rehashing the same stuff everybody's been talking about with rates and stuff.
Yeah, it's a real interesting. So let's move on to the issues list there then and talk about this. So if we just go to the headline basically says that more Americans are relying on credit cards to make ends meet, and fewer are able to pay their bills in full at the end of the month. And the statistic is that 46% of credit card holders carry debt from month to month, up from 39% last year. So that was to your point of almost 50%.
Yeah, but there's conflicting data out there, and I tend to follow consumer debt pretty closely because I like that as a metric for how the economy is likely to be doing in the near future. Because when people are struggling or starting to struggle, it's a good leading indicator that the economy overall is going to start to struggle. And so if you look at like just historic, yeah, we're our consumer debt right now, we just hit I think 16 trillion. At the end of Q3. I don't think Q4 numbers have come out yet, but probably higher than 16 trillion. Just to put that into perspective, at the height of the 2008 crisis, or at the beginning of the 2008 crisis, we were down around 12 trillion in total consumer debt. So we're literally a third higher than where we were at the beginning of the 2008 crisis. But if you look at consumer debt payments as they relate to disposable income. So what percentage of our disposable income are people putting towards their debt payments? So whether it's their mortgage payment or their credit card payment or car payment, how much of their income is their debt taking up? It's a lot smaller than it was back in 2008. So in some respects, I mean, the magnitude of the problem is bigger, but at least at this point, presumably people are still employed, making a decent amount of money. We've seen some wage growth. At this point, it doesn't seem like people are at the precipice of getting ready to like default on all their debt. We're not really at 2008 type levels, but it seems like we could be moving in that direction.
Yeah, so I would say I have two big concerns about it. First is the speed at which it's increasing. And the second is, what are they paying on this debt? Because, so you're right. I've only been able to see Q3. We haven't been able to see, it's too early to see Q4. But if you look at the third quarter of 2022, household debt rose by 351 billion. And that is the largest quarterly increase since 2007. Credit card balances were up 38 billion. Which on a year-over-year basis is a 15% increase, which is the largest in more than 20 years. So I would say the speed at which that is increasing, I mean, it makes sense, right? It's people got accustomed to a certain lifestyle, and as the economy gets a little bit tighter, they want to keep that lifestyle, and they rely on debt a little bit more than they normally do. That was great.
Inflation.
True. And that was great back when money was free, when the Fed fund rate was zero and mortgage rates were low and people could refi their mortgages and take out money and get HELOCs and do all this stuff and have all this access to money. Well, we're not in that market anymore. So if you just look at credit cards, just last year in Q2, the average APR on a credit card was 15.13%. Q4, it was 19.07%. Wow. So not only are we rapidly increasing the actual debt amount, what people are paying on this debt is rapidly increasing too, with all these Fed fund rates, which I think can just be all of a sudden people just can't pay anymore.
Yeah, and certainly that all factors in. I think the big question is, where do we see wage growth going? because if wage growth can kind of keep up with inflation, and again, we talked about inflation starting to slow. If inflation stays low and wage growth stays strong, and people don't go crazy with continued spending, in theory, we could, as the Fed would say, engineer a smooth landing. But the reality is we're likely to see unemployment spike at some point soon, just because it looks like the Fed wants to get us there. And at that point, we're going to see some people, a lot of people potentially, who are going to default on their debt. And when you start defaulting on things like consumer debt, that leads to defaults because people can't refinance their houses. So that leads to defaults on mortgage debt, and that leads to foreclosures. And so all of this can really start to snowball. So it's really a question of can this problem be pushed off long enough to the point where the economy starts to recover and wage growth continues to grow, and people can kind of catch themselves before they start to fall, or has it all started to snowball and it's just a question of when it starts to collapse?
Relying on people catching themselves before it starts to fall, it's just a whole, like, if you look at the Fed, first of all, you're talking about jobs. It's one of my pet peeves, where people saying, okay, we just need the unemployment rate to go up, and then the Fed's gonna do their pivot. If you look historically, it's never worked that way. The Fed has already pivoted. The Fed is actually already cutting rates by the time the unemployment actually goes up. Jobs are sticky. Unemployment is sticky. People don't want to fire the people that they just spent so much time hiring. And so it's not until we've already kind of realized that, okay, we're in a recession, that you see that unemployment rate go up. So you're not going to see that in time. We're already, the last 4 times that the Fed cut rates, unemployment didn't go up until after they'd already cut the rates. That's the first one. And I have a fun statistic here about people, their opinions of their own financial situation. So you want to talk about people catching themselves. So they did TransUnion did a consumer pulse study, and it found that 52% of Americans are optimistic about their financial future during the next 12 months. It gets even worse with young people. Young people, millennials, 64% are optimistic, and Gen Z are 61% optimistic. Now, they surveyed those same people, and 82% of them believe that the U.S. is either currently in a recession or will be in a recession before the end of 2023. So 83% of them believe that we're in a recession or will be in a recession, yet 60%, especially 64%, let's look at millennials, 64% of them believe that they're going to be great next year.
So basically 50% of millennials, so 80% of, if you want to...
No, 64% millennials.
80% of them like think that things are bad, but they're doing fine.
They're going to do fine. Things are going to get bad, but I'll be fine. So statistically, that just doesn't work out. So when you think about, your opinion of people catching themselves in time, I don't think that really holds water.
Yeah, I can't disagree with you. I'd like to think that we live in a nation of rational people who are going to do the right thing. But I guess when you have a couple 100 million people who often act irrationally, they're not going to be able to overcome or they will overcome economic forces simply because I don't think the economy can overcome a whole nation of irrational acting. I don't know what else to say.
Yeah, there's no doubt that there's going to be an issue with the high levels of consumer debt, and with the interest rates continuing to go up and up and up, it's going to become more of an issue. I guess it's still to be determined how big of an issue it will be, whether this will be the thing that breaks the economy, or I'm guessing something else will probably break before that. So, that was a great discussion. Should we move on to to-do lists?
Yeah, let's move on to our to-do list.
I know you and Ashley for sure are going to Vegas because I am not invited and you're going without me. So I know you have that on the agenda.
Yeah, in our defense, it is not a vacation. I'm not taking a vacation with your wife. This is a work trip. So at the end of January, we have a conference called NMHC, and it's the biggest multifamily broker conference in the country every year. This is where we go to find deals, hopefully, and network with brokers and start to break into new markets and potentially find other multifamily operators to work with. And so anybody that's listening that might be in Las Vegas, I think it's like the 31st of January through the 2nd or 3rd of February. If you're in Vegas, let me know. Happy to meet up and would love to say hi. But that's kind of our big thing for February, or for end of January, beginning of February.
Yeah, it's a couple weeks away, but I'll probably bring it up again next week, just because I'm not bitter at all that you guys are going without me. All right, let's wrap this up. How are you going to rate this meeting we have?
I thought this was a good one. We had some good discussion. I thought we had some good news to announce with respect to the economy. I'm going to go with an 8.6 on this one.
8.6. Wow, you're really up there. I would say we had some good discussions, but finding out that The Rock can't do Lego brings us right back down. So I'm going to go with another 8.0 for the rating. How do you want to sign this one off?
So you've done so well on the quotes the last couple of weeks.
You're just going to keep it going up?
Yeah, let's do the quotes again. Give me something. What do you got?
So I obviously have one prepared, and I know a lot of people are thinking this has been a bit of a sucky year in general, but they just have to keep in mind, if the world didn't suck, we'd all fly into space.
It's good. And for those out there that don't know, Kyle has a physics degree, so this fits.
Yeah.
This is Kyle, you have a physics
Backed
degree.
by science.
Yep. And so this is right down your alley. Yeah. Making that vacuum of space joke, I guess.
Yeah, I'd say astronomy was always my worst part of the physics, but yeah. Thanks for everybody for tuning in this week and sticking it out again. I hope you enjoyed the last Drunk Real Estate. I don't know what we have coming up on the next one, but we hope you keep subscribing, smash that like button, and I appreciate your time coming out.
Thanks, everybody.